Hello everyone, welcome back to Just Invest Today, and in today's video I'm responding to this video of Everything Money. They talk about Robert Kiyosaki. They kind of respond to kind of his TikToks. Everything Money is a great channel, go follow it, but I just want to give my own thoughts on what he was saying because I think he doesn't really understand where Robert is coming from, because I kind of watch probably more Robert than he does, so I don't think he really grasps the concepts that Robert is spitting, because he comes from the cloth of back in the day. He was a war vet. He doesn't trust the government. He doesn't do stuff the natural or the kind of the way that most people do stuff. So I'm going to give a different perspective on this video. This is basically talking about the stock market, talking about Bitcoin, talking about assets, liabilities, all of that in the video. So let's get into it right now.
So
I borrow money, guess what? Do I pay taxes on debt? I guess no.
Correct.
Why is that? So when they let out money, that's how money is created. Money is debt. Why is debt tax-free?
What?
I don't know. Because that's how money is created.
Nope, that's stupid. That's wrong.
keep going.
And so the banks love it. They love
No, wrong.
lots of money.
Here's why.
So how
Am I waiting for this thing to end before I say? Oh my gosh.
can I buy assets? The poor person borrows money and buys liabilities like purses, cars.
No, purses and cars and houses are still assets.
Here's a fundamental difference between kind of Robert and Paul. Yes, they're assets because they do have value, right? But when Robert talks about assets, he's talking about resources that actually produce income. And I think that's the difference in thought process between Robert and Paul. Resources that actually produce cash and cash flow, income. So that's the kind of difference, because think about it, purses, that's a liability. When you buy a purse, you're not thinking about how you're going to make money on that purse, right? Usually when people buy a purse, they just use it out, and then after it's done, they just throw it away. It doesn't provide any economic value unless you're like a purse dealer, or unless you buy this high-end purse like a Birkin, and then you sell it for a future value, and you know probably the price is going to go up in the Birkin because it's a limited edition. Yes, then you can kind of see it as an asset. But usually when people buy purses, I'm talking about the majority of people that are buying purses and cars, it's a liability. Like, you put more money into gas, into maintenance, into just everything with a car. It's an asset because you use it to actually get more money. Usually you go to your job, you go to work, whatever. But when you buy a car, usually you sell it and you're getting less value for it. And even when you sell it to get less value, you still have to buy another car to produce that same income, right? So yes, it's an asset, but is it really an asset? Because it's not really generating income for you. Actual cash flow from the actual car or the purse or the house. If you're not actually producing cash from it, then he doesn't consider it really an asset. He considers it a liability. So that's the fundamental difference.
They're still he's 100% wrong.
Yeah. Oh my gosh.
He's 100% wrong. Here is why you don't get taxed when you take on debt.
Tell me.
The reason being is, where was the sale? Where was the transaction that generated income? When you take it's very simple for you accounting people out there. Where's my freaking marker? There's a thing in accounting, when you increase cash, and when you increase liabilities, it's a debit to liabilities. Let's say $10. Cash is $10. Where's the income? It's a balancing. This is accounting. This is accounting 1-1. This is literally usually if you take cash in for $10 with a sale, there's income of $10. But instead, we took the cash in and now it's debt. Income's been removed. That is why liabilities are not taxed.
He's sort of saying it's an incentive. Liabilities are an incentive to push people to go buy something because
well, of course that's the case. But that doesn't mean it's a liability. That doesn't mean that asset. If I go buy a house,
your house is not a liability.
Yeah.
Yes, it is. Your house is liability. Like, that's why people don't really understand it, because think about all the money that you put into your house. Yes, it creates value, but people are not using the value of their house to generate income. They're paying maintenance fees, they're paying for electricity, they're paying for all of this extra stuff to actually have a house, like your property taxes, like all that stuff is an expense on your asset. And when you think about it, you never use that asset to make money. And that's the whole point. You never use it to make money. Think about it. Most people are not cash refinancing their house to buy another asset, to make that asset make money. People are not doing that. When people have a house, they literally don't make money on it. They buy a house, and if they sell it, say you sell a house and you make 100 or 200,000 profit on that house. First, it's a taxable event, so you don't get that full 100, 200,000, 20%, and then on top of that, you have to buy another house. How many people buy a house to downgrade to buy a cheaper house? That is usually not what people do. So if you're doing it to buy a house and then you're buying a cheaper house so you make money on that, okay, it's an asset. Or if you're renting it out, yes, it's an asset. People aren't doing that. They're not using their house to actually, their primary house to make money on it. People buy a house, they sell it for 2-3 million and they make a profit of what, 500, 600,000. They just buy another house worth that much. People really don't wait for a crash or whatever to happen in the housing market. They buy another house worth the exact same much or more as the prices increase. So you never make money on your house. So yes, it's a liability. You've literally not used any money and it's just been all costing you. It's all been an expense the whole time you've owned a house. But yes, you still need a house. So he doesn't consider it an asset because it doesn't produce any income. That is the fundamental difference between Robert and Paul right now, which is kind of like, I understand his point of view, but you have to understand Robert and where he's coming from when he talks about assets.
By the way, this is just like when people say stupid, like, oh, if the bank owns your home. No, they don't. The bank does not own your home.
Yeah, they do. What? If you own... Okay, wait, that is crazy. The bank really does own your home. If you don't make payments on the home, they literally take it away. How is that ownership when the bank can take your home away if you can't pay for it? Like, that makes no sense. Like, anything that you own, it can't be taken away by force. Like, it can't be taken away by the government if you really, really own it. If I buy a bottle of wine, why would the government wants to take it away, but he can't because I own the wine, essentially. The bank owns your house when it has more debt, when you owe on the house. So yes, they actually do own your home, and they own the land that your home's on. So yeah, they own your home.
That's our next clip, Tim.
I don't get this. Like when people talk about this, I'm like, the bank owns your home. Why? Well, because they have the debt on it. Your equity's so low. But who owns the home then? Who owns the entire thing and then owns a part of it? When the value goes up, does the bank include in that?
Does the bank get included in it?
No.
Yeah, they do. Like what? Your property goes up if you sell it. The government takes money from your sale. What are you talking about? They take money. The little government, the federal government takes money from you. So yeah, they own it pretty much. Yeah. Anything that you sell, basically the government owns it, honestly. Even stocks, in my opinion. Like Warren Buffett even says the government is the biggest business. Like think about it. They take a profit off that sale. So yeah, the government, yeah, pretty much.
Then they don't own the fucking home. God.
Wait till you
people who listen to that go, no, that's not the. And you know what? Most people out there, they don't understand. So they go, well, Robert Kiyosaki. I remember
Paul,
20
I
years
think
ago.
that's me because it makes a lot of sense to a dummy like me until you.
Yo, Paul's funny. I'm not gonna lie.
Next
like,
video.
he says something right and then he goes wrong and you're like, oh, that's probably true also.
I'm not saying I'm right on everything, but I'm sitting there saying, like, at least when I make a statement, it's based on some sort of logic. Him saying that the reason we don't get taxed is because the government loves debt, it's like me saying 2 + 2 is orange. It's like, that doesn't make any sense whatsoever. The reason...
I agree with that 100%. That is definitely not the case, so I agree with Paul on that statement.
It's not, when you refinance your house and get a big check, the reason you'll get taxed on that check is because there was never a transaction we made that generated income. There was no income made. You took wealth from one hand and put it in the other hand. You took equity from your home and put it in your bank account. It was just a transfer of wealth. No transaction. There was no sale of any asset that occurred. Zero sale of an asset, which is also why...
But that is the key. That is the key. And that's what Robert talks about. You use the government's money to buy assets and you never have to spend your own money. That is the little key to wealth, because when you actually sell your home, you're getting a taxable event. So why wouldn't you just refinance your home, take the cash out, you don't get any government taxation, and you buy another asset producing cash? that's how you literally make money, and that's how you continue to make money. I think that's the fundamental difference that Paul is not understanding here.
As an example, let me give this example out here. Let's say you buy a house for 100,000, and you put 80. It gives you equity out of your house. The house tomorrow for 200,000. Actually, there's 200 minus 100 because you bought it for 100, you sold it for 200. Even though you got no money at closing, you still have a gain on the asset.
Well,
Good call.
you talked about him not knowing about assets because he's a big fan of Bitcoin, and we're going to get into that right now. As if he's a specialist in
There we
assets.
go. That's the asset.
Video number 3.
Which is better, gold or Bitcoin? Who cares? The question is, how much do you have? That's all that counts right now. Because the reason you buy gold, silver, or Bitcoin is for the same reason. If you trust the U.S. government or the central banks, the Fed, and Wall Street, then save money. But if you don't, then buy gold, silver, and Bitcoin. And the thing I like.
All right, cool.
Silver and Bitcoin are exactly the same
So
thing.
let's
They're
go.
all the hedge.
You know what? He's right. He's right.
pull it up,
So
baby.
let's go pull it up.
Yep.
Let's go check out how gold versus Bitcoin is done this year. Genius.
For those of you that are wondering.
So
Why would they use a 1-year example? That's like the stupidest argument ever. It's like, oh, your stock's down 50% in 1 year. Oh, look what your stocks have done. Like, that means it's a garbage purchase. It's a bad purchase because your stock went down 40, 30% in a year. You don't look at assets in 1 year. Your house can go down in value in a year. That means nothing. We're looking at history, 10, 30, 40, 50. That's what you're looking for. You don't look at, who looks at 1 year? Even Paul, like, for Paul, like, that is crazy that he would actually look at 1 year.
here's
Bitcoin is the
gold.
hedge against inflation.
Makes no sense.
Here's gold. Here's gold. 1 year of gold. Ready? 1 year percentage. It is up 2%.
Why don't you look 200 years? Who looks 1 year for an asset? 1 year, anything can happen. What?
In the last 1 year. Okay, let's go to Bitcoin. You buy gold, silver, and Bitcoin. So let's go to Bitcoin. Let's go to 1 year for Bitcoin.
Definitely treating them as the same.
Why don't you look at Bitcoin when it was $100? It's actually done more than like 100% of stocks to this point. If you actually look at the returns from when it was $100 to now, it's done way better than more than half of the companies. So he's just talking out of his mouth. What if in the next 10, 15 years, Bitcoin is like at 300,000 or 200,000? No one knows.
Yep, they're the exact
Yeah, they're
same
the
thing.
They're all hedges.
Down 44.7%.
Not bad.
That doesn't mean nothing in a year. It means nothing. Baba, an asset producing company, is down 50%. A lot of stocks are down 40, 50% that actually produce income. That doesn't mean anything. We're looking at 5-year averages. 5, 10, 20.
Bad.
That's all I have to say about that, about Bitcoin.
What?
He's just pumping. His income is made from selling things. That's why I always say to people, watch.
No, his income is made from holding things and not believing in the government. That's why he's saying gold, silver, and Bitcoin. Stuff that you hold that has nothing to do with the Fed printing money and devaluing the currency. That's all it's about. It's not about selling. He actually just holds any property he holds. He doesn't sell. So that's wrong. So that's it for the video, guys. There was a lot more to talk about in this video, but I didn't want to make it too long. So what do you think about my reaction to Paul? Guys, click that like button, subscribe to my channel. Peace.